How does the home office deduction affect capital gains tax when selling a home? Have you ever wondered how the home office deduction might influence your capital gains tax when selling your home? Let's break it down in a straightforward way. When you claim a home office deduction, it can indeed affect the taxes you owe when you sell your home. This is especially important for homeowners and real estate investors to understand. First, if your home office is part of your primary residence, you can still qualify for the capital gains exclusion. This means you can exclude up to $250,000 of profit if you are a single filer, or $500,000 if you are married and filing jointly. This exclusion applies even if you have claimed home office deductions. However, there is a catch. The home office deduction often involves depreciation. When you take depreciation deductions for the office space, it reduces your home's tax basis. When you sell your home, the Internal Revenue Service requires you to recapture that depreciation. This recapture is taxed at a maximum rate of 25%, which is higher than the typical long-term capital gains rate, usually around 15%. If your home office is inside your home, you do not need to separate the sale into personal and business portions. The entire gain can qualify for the exclusion, except for the depreciation recapture on the office part. This makes it easier for homeowners to manage their taxes. On the other hand, if your home office is in a separate structure, like a detached garage or guest house, the rules change. You will need to allocate the gain between personal use and business use. The gain from the office structure may not qualify for the exclusion and could be fully taxable, including the depreciation recapture. To claim the home office deduction, the space must be used regularly and exclusively for business. It should also be your principal place of business. Eligible expenses can include a portion of mortgage interest, utilities, insurance, repairs, and depreciation. The Internal Revenue Service also offers a simplified home office deduction method. This option does not allow for depreciation deductions, which means you avoid depreciation recapture when you sell. If you choose the simplified option, you will not owe recapture tax, but you also cannot claim depreciation deductions during the time you own the property. For homeowners and real estate investors, understanding these rules is essential for financial planning. If you are self-employed or run a business from home, the home office deduction can lower your current taxable income. However, it may increase your taxable gain when you sell due to depreciation recapture. Planning is key. Consider the trade-off between current tax savings and future capital gains tax when using the home office deduction. If you plan to sell your home and want to maximize the exclusion, you might want to consider the simplified deduction to avoid depreciation recapture. Keep detailed records of any depreciation claimed. This will help you accurately calculate the recapture tax when you sell your home. Understanding these factors can make a significant difference in your financial planning, especially if your property serves both residential and business purposes.